explaining the sale of covered options is a little difficult because in some ways it's sort of counterintuitive. So I always try to come up with analogies that might clarify what it is. So one analogy is to compare it with buying and renting a house. The value of the house over, say, 30 years is going to vary. And at the end of the 30 years or whatever your time frame is, it would be liquidated at its current market value. But over that long period of time, you're more likely to collect rent that is greater than what you paid for the house. So anything you get in liquidation of the house is just plus money. And it could go up. So in that regard, that's very much like selling stock option contracts. Remember, what you're selling is a contract whose value is derived from the underlying stock. So your liquidation value of your account will go up and down, up and down, up and down, even though you're collecting considerable premiums along the way. So someone I know has been hesitant to jump into it because they put their toe in the water and they saw their liquidation value of their account drop. Well, this is where the counterintuitive part comes in, because basically all that time that person was collecting premiums all along. So selling stock options is not for today, tomorrow, next year. It's for the rest of your life, really. But it'll provide a great income stream. Last year, in terms of my taxable income, it was 80% based on the money I had at risk. Well, what's wrong with that? And that's just the taxable income. And that taxable income is a capital gain, which is taxed oftentimes at a lower rate than ordinary income. So it's all about the income. And the way you measure your success in the long term is either by taking some of that premium income out and using it, or by seeing the number of contracts that you can cover increase. Because as you can cover more contracts, the income stream increases, regardless of what the current market value of the stock is. I mean, really, the only worry you might have is that the company goes out of business. Then if you hold any of that stock, that's a total loss. That's the reason selecting a good stock, that is one with a good balance sheet, a good placement in the market, unlikely to have any technical surprises, is very important. Now, my favorite is Hayes Brands International. They make underwear. So the business was started in 1905. It has a decent balance sheet and it pays a decent dividend, and it's been doing that for many years. So I don't see any kind of technical thing on the horizon that's going to eliminate the need for underwear. In some ways, it's not a glamorous business. I was doing a software project for a clothing manufacturer, and the owner of the company said something that's always stuck with me. He said, In the clothing, in making clothes or any textiles, it's a pennies business. If you be sure you're making some pennies, and you're going to make some dollars. But anyway, that's enough about that particular company. The point is that I've seen the price range of Hanes brands range between $22 and its current eight, around 880, 890. So, and yet, even with that huge price decrease, I'm able to cover more contracts and increase my income. So that's very important. All right, I think the best way to proceed on this is to show you some screens and talk about those. So I'm going to switch over to sharing my screen. This last quarter, and will likely do so in the next quarter, because as the recession takes hold, people are going to buy less of everything, including underwear, and the retailers already have surplus inventory. So the retailers' orders to HPI are going to decrease until that inventory is worked off. But it doesn't change the nature of their business. They make a profit, just a question of how much. And as long as they can continue to support their dividend payout, that stock is going to stay pretty much like it is. I did a calculation. It looks to me like the liquidation value of the company is around $8 a share. So at any rate, as it goes down, remember, it takes less of my money to cover the contracts. So I can write more contracts. This is on my current transaction set. As of yesterday, I had taken in $2,855. That worked out for that day. This is a moving number, of course. Daily premium of $285.50. Here again, that's a big percentage of the money I have at risk. I mean, you can extrapolate the amount of money I have at risk by taking the number of shares that I'm covering, which is 1,800 shares of HBI times the market price, and that tells you the market value of my portfolio, plus some cash. But I try to fold my cash right back into writing new contracts. So at any rate, this is an important page, and it changes every business day. So this is when the stock, I mean, the page that brought you to this, that is the index page, is one you need to put in your favorites list. Like today, the market's not open yet, so that's all we see. And anyway, use the comments section to ask questions. Also, notice the links I have to the various pages, particularly the one on the transaction set. That's a PowerPoint presentation. You should print that out and study it until you thoroughly understand it. It won't be until you understand that you'll have any grasp of what this is all about. The last thing I thought I'll leave you with is don't get greedy. Let me see if I can get over to. So the market price is between $8 and $9. So if I sold a call contract at $8, which means I'd have to have the stock in my portfolio to cover that, I can hopefully draw 81 cents of premium income per share, which would be $81 per contract. Yeah, $81 per contract. But I'm selling it. That would set a strike price below the market. And that's not to say you shouldn't do that. That's the thing you need to understand. But here's where some people who have tried to do this fail. They'll look at this 750 strike and say, "Oh, that's $1.20 per share. So that's $120 per contract. Shouldn't I do that?" Well, if the market or the price of HBI really drops, yeah, that might you would be a genius because you're leveraged. It's further away you get on a strike from the current market price, the more leveraged you are. It pays a bigger dividend, but there's a reason why, or a premium, but there's a reason for that. That is, you're leveraged. So I try to not go, like if this current stock price now, I think it's 880 something. So the premium for a $9 call, which would be very safe, is 15 cents a share, or $15 per contract. At $8, it's 81 cents, or $81 per contract. Probably what I would do is, let's say I had 800 shares in my portfolio. I'd probably write 4 of them with a $9 strike and 4 of them with an $8 strike. Remember, I obtained this stock by having a put exercised, and I got a premium on that. So the two premiums, if they're constantly been exercised, need to offset the difference in the stock price. And that's not really true either, but because you're looking at a snapshot. Getting back to the house that you're renting analogy, the market value of that house may change from day to day to day to day, but the income continues. Well, that's sort of the frame of mind you've got to have here. Except that here you don't have a possibility of a tenant tearing up your house, and the other maintenance required for keeping the house livable. Anyway, another story. The beauty part about this is you don't have to go out and make sales calls. You don't have to. I have no idea who buys my options that I write. Remember, these contracts don't exist until I write them. And I write that just by placing an order to sell something I don't have. All right, and that I'm actually, in other words, that creates the contract that didn't exist before. When you look at your brokerage account and you do this, it says you're selling short. Okay. But whatever you're doing there, in terms of how you look at it, it brings in a steady income. Remember I said I took out $10,000 out of my account a year ago. Well, I've recovered about 60% of that in a year, a little over a year. Well, that's a damn good return on investment. But you've got to be conservative. It's in some ways this is dull. But anyway, I'm not going to labor that point anymore. Okay, I think that's about as much as I need to cover in this session. Okay, I'm going to leave it at that. And if you're getting any benefit of this at all, please click on subscribe and notifications, because I post to this frequently, and hopefully you'll benefit from it. Have a good day.